Hello, my name is Lawrence, and alongside Ayana and Anisha, we are Aurora Advisory. We have conducted an in-depth analysis of Boeing's financial and operational performance. Our goal is to provide a clear, actionable perspective for State Road Global Advisors. Let's begin with Boeing's capital structure. Boeing's capital structure reveals a heavy reliance on debt financing, which has been amplified by a significant share buyback over the past decade, totaling $40.64 billion. This strategy has led to a negative equity balance, placing Boeing in a unique financial position compared to its peers. On the debt side, Boeing has issued various long term debt instruments, which are subject to covenant restrictions, limiting its financial flexibility. The company's high leverage, measured through its debt to equity ratio, makes it more vulnerable to economic downturns or revenue disruptions. When compared to competitors like Airbus and Lockheed Martin, Boeing's financial structure stands out due to its increased reliance on borrowing. This approach, while enabling aggressive capital investments and shareholder returns in the past, now adds significant risk during times of uncertainty. As managers, understanding the structure is crucial to assessing both the opportunities and risks associated with Boeing. Next, let's examine Boeing's revenue and expense sources. Boeing's revenue is primarily derived from three segments: commercial airplanes, defense, space and security, and global services. Commercial airplanes account for the largest share, generating $33.9 billion in 2023. Defense, space, and security follows with $24.9 billion, and global services contributes $19.1 billion. Geographically, Boeing's revenue is diversified, with 62 coming from Americas, 15 from Asia Pacific, 14 from Europe, and 9% from Africa and the Middle East. This distribution highlights the company's strong foothold in North America, but also its significant reliance on global markets. On the expense side, Boeing faces high costs in manufacturing, research and development, and logistics. For example, the commercial airplane segment incurs $31.8 billion in expenses due to the high costs of production and unpredictable factors like fluctuating material and logistics costs. Defense operations also involve significant R&D expenses, averaging $2.85 billion annually. These figures underscore the challenges Boeing faces in maintaining profitability while managing operational complexity. Finally, let's discuss Boeing's main competitors. In the commercial and defense sectors, Airbus is Boeing's closest rival. Airbus has outperformed Boeing in several key areas, including market share, profitability, and order backlogs. For instance, Airbus achieved record-breaking orders in 2023 and currently dominates the single-aisle aircraft market with an 80% share compared to Boeing's 20%. Other key competitors include Lockheed Martin, Northrop Grumman, and General Dynamics, who specialize in defense systems and weaponry. Each competitor presents unique challenges to Boeing, ranging from innovation to financial stability. This competitive landscape emphasizes the pressures on Boeing to innovate and manages costs effectively while addressing operational challenges. I'll now pass it on to Ayana.
Next, we analyzed Boeing's share price from November 2023 to October 2024 to see what events may have caused an increase or decrease in their prices over the last year. There was quite a large spike in Boeing's share price during December of 2023, which can be attributed to Boeing setting a new company backlog record of 6,216 jets, which led to a price share increase of 12.5% from the previous month. However, as we move into January of 2024, share prices begin to decrease for Boeing and would remain low for the rest of 2024. The key incident that led to this continued decrease was a door falling off mid-flight on an Alaskan Airlines flight, which was a Boeing 737 MAX plane. This caused a major grounding of Boeing's best-selling jets, causing share prices to drop by 8%. After April of this year, share prices began to increase again and hit a peak in July with an increase of 0.96% in their share price. This was mainly due to Boeing pleading guilty to the Department of Justice for misleading airline regulators after two major crashes occurred with their 737 MAX planes, which killed 346 people. In August, Boeing's stocks plunged by 7% in one day after a Wall Street research company analyst downgraded Boeing's stock due to their cash flow target of $10 billion to not be met by 2026. Currently, Boeing is down by 1.6% and trading at $147. It is a two-year low for the company caused by Boeing's withdrawal of a contract to the striking machinist union. Here we can compare Boeing to their close competitor Airbus, which is Europe's largest space and aeronautics company, with their products ranging from commercial aircraft to defense and space projects. As seen in the price graph, Airbus's price has remained below Boeing for the last year, But in October of 2024, due to Boeing's many controversies, Airbus's price is now similar to Boeing. Furthermore, Boeing has had major losses since 2019, while Airbus has grown their profit margins by 5.2%. Airbus's stocks have also been performing better than Boeing. Boeing stock has declined by 20% since January of 2021 in comparison to Airbus, which has grown by 60%. With the knowledge about Boeing's controversies and the decline of their stock and profits, Airbus currently seems to be a strong competitor who may outperform Boeing by the end of the year. Airbus is currently dominating Boeing in orders and with single-aisle planes. The ratio between Airbus and Boeing in their market share is currently 80 to 20%. In the May quarter, Airbus also announced a 28% increase in their net profit. Although the share price of Boeing is currently higher than Airbus, being $149.31 to $140.16, Airbus has shown considerable growth this year in comparison to Boeing. Moreover, Airbus's market share has increased significantly due to the development of a new, highly efficient, cheaper mid-sized plane that Boeing has yet to match. Next, we will be discussing the positive surprise and negative events. A positive surprise event was Boeing's CEO, Dave Calhoun, announcing he was stepping down by 2024. On the announcement date, which was on March 25th, share prices rose by 0.9% and the price increased by $2.56. The trading volume also increased by around 3.4 million units compared to the monthly average, which is an increase of 26.41%. The positive impact of this event can be seen by the 0.9% share price increase. This is because under Calhoun's leadership, Boeing has been involved in many controversies, such as the Alaskan Airlines flight incident where the plane door fell off. This price change further indicates that the market believed this action would improve the company's recent controversies in areas such as manufacturing. Boeing is now in a major reshuffling of its senior management due to the above-mentioned controversies.
Now moving on to the surprise negative factor and the market response. So Boeing's market performance during June 15th to 20th was significantly influenced by the surprise factor. On June 15th, the FAA unexpectedly delayed approval of modifications to the 737 MAX. This led to an immediate 2.1% drop in Boeing's share price. Just a few days later, on June 20th, an analyst downgrade resulted in an additional 1.3% decline, culminating in a combined 3.4% drop over the week. The regulatory delay amplified fears about Boeing's ability to meet compliance requirements and maintain production schedules. This concern was evident in the heightened trading activity and stock volatility during the period. As shown in the media articles, FAA grounds dozens of the 737 MAX aircraft. This focuses on how the FAA decision raised doubts about the long-term reliability of the 737 MAX and its certification process. And analysts lower Boeing targets amid regulatory uncertainty, where analysts express skepticism about Boeing's recovery timeline, with some revising their stock price targets downwards. The downgrade, published just days after the FAA's announcement, cited increasing regulatory hurdles and potential risks to profitability. So these developments signal significant challenges for Boeing. So the FAA's decision to ground dozens of 737 MAX aircraft further tarnished Boeing's reputation with both regulators and airline customers. So this is especially damaging given that the company is still recovering from the 737 MAX crisis. Addressing these regulatory issues will require additional resources, potentially pressuring profit margins and delaying deliveries. This could ripple through Boeing's relationships with key stakeholders and impact shareholder returns. So the graph shown on this slide shows how the stock price dropped steeply following these events, illustrating the market's rapid reassessment of the Boeing's value. So the 7.55% total decline over the week underscores the heightened risks perceived by the investors. So then these events provide insights into market reactions consistent with the semi-strong form of the efficient market hypothesis, which asserts that stock prices promptly reflect all publicly available information. So the unexpected regulatory decision had a significant impact, resulting in a 7.55% decline in Boeing's stock by the end of the week. This reaction indicates that the market efficiently processed the new information about production delays and potential financial setbacks. The scale of the price drop suggests that the news was worse than anticipated, as investors likely expected substantial consequences for Boeing's production timelines and costs. The rapid adjustment aligns well with the EMH, showing that stock prices reflect new information almost immediately without any lag. In contrast, however, the CEO's planned departure had a more muted impact on Boeing's stock price, causing only minor fluctuations, though it did lead to a noticeable increase in trading volume. This reaction may suggest that this market was already prepared for some level of leadership transition, or that the news did not significantly alter investor expectations for Boeing's future. The volume spike reflects active speculation, but the modest price change aligns well with the semi-strong EMH, as the market quickly processed the news without major impact on valuation. So, moving on to investment strategies for managing risk. So, given these challenges, we recommend 3 key strategies to safeguard investments and optimize returns to asset managers at State Road Global Advisors. So, the first one being the immediate sale of Boeing shares. So, selling Boeing shares outright allows us to mitigate exposure to ongoing volatility and reinvest in more stable, diversified assets. With the constant stream of negative publicity and regulatory setbacks, this is the most conservative approach to protect against further losses. The second one is risk mitigation through options. So a long put option strategy offers a balanced approach. So it allows us to profit if Boeing stock price continues to fall while limiting losses to the premium paid. This hedging mechanism provides flexibility and protects against downside risk, ensuring controlled exposure to volatility. And the final one being reducing exposure through diversification. So diversifying our portfolio across other sectors such as technology, healthcare, and fixed income securities can stabilize returns. This approach reduces reliance on Boeing and protects against the firm-specific risks highlighted in these recent events. Thank you.